Many people hear the words business finance and immediately think about complicated spreadsheets, accountants, or difficult formulas. In reality, business finance is simply the story of money moving through a business. Money comes in, money goes out, and the business owner must understand where it is coming from and where it is going. Imagine a lemonade stand. You spend $10 to buy lemons, cups, sugar, and ice. Then you sell lemonade and collect $20 from customers. At first glance, it may look like you made $20, but that is not true. You first spent $10. Your actual profit is $10. This is the first lesson of business finance. Revenue and profit are not the same thing. Revenue is all the money you collect from customers. Profit is the money left after paying expenses. Many business owners get excited when sales increase, but they forget to look at expenses. A business can sell $1,000 worth of products and still lose money if expenses are higher than income. Smart business owners track every dollar that enters and leaves the business. They know how much they spend on products, marketing, rent, software, employees, and taxes. When you understand the flow of money, better decisions become easier. Business finance is not about being a math genius. It is about paying attention to what your money is doing every day. Cash flow is more important than most people think. One of the biggest reasons businesses fail is poor cash flow. Cash flow simply means having money available when bills need to be paid. Imagine a bakery receives a large order worth $5,000 from a customer. The customer promises to pay after 60 days. The bakery owner becomes excited because the sale looks great. However, during those 60 days, the owner still needs money for flour, sugar, electricity, employee salaries, and rent. If there is no cash available, the bakery can struggle, even though a large sale was made. This is why cash flow matters so much. Think about a water tank. Revenue is the water coming into the tank. Expenses are the water leaving the tank. If water leaves faster than it enters, the tank becomes empty. The same thing happens in business. A company may look successful from the outside, but still face financial problems because cash is running out. Smart business owners regularly check how much money is currently available in bank accounts. They create emergency reserves for unexpected situations. For example, if monthly business expenses are $3,000, a good goal may be to save enough cash to cover several months of operations. This creates stability and reduces stress. Businesses rarely fail because they lack ideas. Many fail because they run out of cash before their ideas have time to succeed. Every expense should have a purpose. Successful businesses treat money like a valuable tool. Every dollar spent should help the business grow, improve, or operate efficiently. Imagine two store owners. The first owner buys expensive office furniture, luxury decorations, premium gadgets, and subscriptions that are rarely used. The second owner focuses on inventory, customer service, marketing, and systems that improve sales. After 1 year, the second owner is usually in a stronger financial position. Many small expenses seem harmless at first. A few unnecessary software subscriptions, random delivery charges, premium memberships, and impulse purchases may not look important. However, small expenses repeated every month become large amounts over time. Imagine spending $20 every month on a tool that nobody uses. After 1 year, that becomes $240. Multiply that by several unused services, and the losses grow quickly. Smart business owners regularly review expenses and ask simple questions. Does this expense help generate revenue? Does it save time? Does it improve customer experience? If the answer is no, the expense may not be necessary. Think of business money like fuel inside a car. Fuel should be used to move the car forward, not wasted while sitting still. When business owners control spending and focus on value, profits usually improve. Good financial management is often less about making more money and more about avoiding unnecessary waste. Understanding profit helps you make better decisions. Profit is the reward for running a business successfully. However, many people misunderstand how profit works. Imagine a toy store sells products worth $10,000 in 1 month. That sounds impressive. But now let's look closer. The store spent $4,000 buying inventory, $2,000 on employee salaries, $1,000 on rent, $500 on marketing, and $500 on utilities and other expenses. Total expenses equal $8,000. The actual profit is only $2,000. Without understanding the numbers, someone might incorrectly believe the owner earned $10,000. This simple example shows why profit matters more than sales alone. High sales do not always mean high earnings. Smart business owners calculate profit regularly and look for ways to improve it. They may negotiate better supplier prices, reduce waste, increase efficiency, or focus on products with better profit margins. Imagine 2 products. One generates $100 in sales and leaves $10 in profit. Another generates $100 in sales and leaves $40 in profit. The second product is usually more valuable to the business. Understanding profit helps owners decide what to sell, where to invest money, and how to grow. Businesses that focus only on sales numbers often miss important financial problems. Businesses that understand profit make stronger long-term decisions. Planning ahead creates financial stability. Many business owners only think about money when problems appear. Smart owners think ahead. They create financial plans before challenges arrive. Imagine a landscaping business that earns most of its money during warm months. The owner knows business may slow down during colder seasons. Instead of spending all profits immediately, the owner saves part of the earnings during busy months. When slower months arrive, bills can still be paid comfortably. This is financial planning. Another example is equipment replacement. Suppose a delivery company owns several vehicles. The owner knows vehicles eventually require repairs or replacement. Instead of waiting for a breakdown and facing a huge unexpected expense, money is set aside every month. When repairs become necessary, cash is available. Financial planning reduces surprises. It also helps businesses grow responsibly. Before hiring employees, opening a new location, or launching a new product, successful owners estimate costs and expected returns. They ask questions such as, how much will this investment cost? How long will it take to recover the money? What risks exist? Planning does not guarantee success, but it greatly improves the chances of making good decisions. Businesses that plan ahead usually experience less stress, fewer emergencies, and more opportunities for growth because they are prepared before challenges appear. Business finance is about control, not complexity. At its core, business finance is not about complicated reports or advanced accounting terms. It is about understanding and controlling money. Imagine a farmer planting seeds. The farmer regularly checks the soil, water, weather, and plant growth. Ignoring these factors could lead to a poor harvest. Business finance works the same way. Owners must regularly monitor revenue, expenses, cash flow, profit, and savings. Consider a small online store. Every week, the owner reviews sales, checks advertising costs, monitors inventory levels, and looks at available cash. These simple habits help identify problems early. If marketing costs suddenly increase, action can be taken. If profits begin shrinking, adjustments can be made before serious damage occurs. Many people believe finance is only important for large corporations, but it is actually most important for small businesses because resources are limited. The good news is that business finance can be understood using simple questions. How much money came in? How much money went out? How much profit remains? How much cash is available today? What expenses can be reduced? When owners consistently answer these questions, they gain control over their business. Managing working capital is not about spreadsheets alone. It is about survival. Every business runs on a simple rhythm, often called the cash-to-cash cycle. This cycle measures how long it takes to buy raw materials, convert them into finished goods, sell them, and collect the cash. Imagine you pay suppliers today, hold inventory for 30 days, sell the product in another 20 days, and then customers pay you after 30 days. Your cash is locked up for 80 days. That means you must fund almost 3 months of operations before you see your money again. The shorter this cycle, the stronger your business becomes. If you can reduce inventory days from 30 to 20 and collect receivables in 20 days instead of 30, you shorten the cycle dramatically. Even a 10-day improvement can free thousands of dollars in cash. Working capital management starts by understanding this operating cycle clearly, because time literally equals money in business finance. Inventory management plays a major role in controlling working capital because inventory is essentially cash sitting on shelves. If you carry too much stock, you create what many finance professionals call dead capital. That money is locked inside products that are not generating immediate returns. On the other hand, if you carry too little inventory, you risk stockouts, lost sales, and disappointed customers who may never return. The objective is balance. For example, assume your business generates $70,000 in monthly sales and your cost of goods sold is $42,000. If you are holding $120,000 in inventory, that equals nearly 3 months of stock. Unless your demand is extremely stable, this is inefficient. Instead, study your sales data carefully. Identify fast-moving items that sell consistently and maintain optimal reorder levels for them. For slower-moving products, review performance every 30 to 60 days. If something has not sold in 90 days, consider discounting it or bundling it to recover cash. Monitoring your inventory turnover ratio regularly helps you see whether products are moving at a healthy pace. The faster your inventory turns, the less cash you need to keep the business running. Smart inventory optimization protects liquidity while still supporting steady sales growth. Accounts receivable management is where many profitable businesses quietly struggle. Revenue on paper does not pay bills, only collected cash does. If you allow customers to take too long to pay, your working capital gets stretched even though sales look strong. The first step is setting clear credit policies. Define your payment terms upfront, such as net 30, and make sure those terms are visible on every invoice and agreement. Do not assume customers will automatically pay on time. You must create structure. For example, if your monthly credit sales are $100,000 and your average collection period drifts from 30 days to 45 days, that extra 15 days means roughly $50,000 more stuck in receivables at any given time. That is significant liquidity pressure. You can encourage faster payments by offering early payment incentives, such as 2% discount if paid within 10 days. While you give up a small portion of margin, you improve cash flow stability, which often matters more. Also, establish credit limits based on customer history. A long-term client with a strong payment record can qualify for higher limits, while new or inconsistent customers should start with tighter controls. Implement a disciplined follow-up system. Send reminders a few days before due dates, follow up immediately after invoices become overdue, and escalate professionally if delays continue. Track your average receivable days every month. Even reducing collection time by 10 days can free substantial working capital. Strong receivable management reduces dependence on borrowing and strengthens financial flexibility. Cash collected faster means more control, less stress, and a healthier balance sheet overall. Accounts payable should be managed just as carefully as receivables, because timing your outgoing cash is just as important as speeding up incoming cash. Many business owners pay suppliers immediately out of habit, but that is not always the smartest move. If your supplier offers net 30 terms, that means you legally have 30 days before payment is due. Using those full 30 days allows you to preserve liquidity without harming trust. In some cases, you may even negotiate net 45 or net 60, especially if you have a strong payment history and consistent order volume. For example, if your monthly purchases are $60,000, extending terms by 15 days can significantly ease short-term cash pressure. However, discipline is critical. Never miss agreed deadlines, because damaging supplier relationships or credit reputation can create bigger problems than temporary cash strain. At the same time, build a rolling cash flow forecast covering at least 3 to 6 months. List expected inflows from customer payments and expected outflows such as payroll, rent, loan installments, taxes, and supplier payments. This forecast helps you identify potential shortfalls early. If you notice a projected gap 2 months ahead, you can prepare backup solutions like a bank overdraft, trade credit, or invoice factoring before the situation becomes urgent. Managing payables strategically is not about delaying irresponsibly. It is about aligning payment timing with your overall operating cycle so your working capital remains stable and predictable. One of the biggest misunderstandings in business finance is confusing profitability with liquidity. A company can report strong profits and still collapse because it runs out of cash. Profit is an accounting result, but liquidity is the ability to pay bills today. If you cannot cover payroll, rent, taxes, or supplier payments on time, profitability will not save you. That is why monitoring key financial ratios is essential. The current ratio, calculated as current assets divided by current liabilities, should ideally stay around 2 to 1. This means you have $2 of short-term assets for every $1 of short-term obligations. The quick ratio goes further by removing inventory from the calculation, showing how much near cash you truly have available. You also need to avoid overtrading. Rapid growth sounds exciting, but expanding too fast without enough working capital can create serious stress. For example, doubling sales may require doubling inventory and offering more customer credit. Without sufficient liquidity, growth can drain cash quickly. Cash accounting is one of the simplest accounting methods a business can use. The basic idea is straightforward. Money is recorded only when cash actually moves in or out of the business. If a customer pays you today, that payment is recorded as revenue today. If you pay a bill today, that payment becomes an expense today. If money has not been received or paid yet, it does not appear in the records. This leads to one of the most common questions business owners ask. How is cash accounting different from accrual accounting? The difference is timing. Accrual accounting records income when it is earned and expenses when they are incurred, even if the cash has not moved yet. Cash accounting ignores those future payments and focuses only on real cash transactions happening right now. Another important question is when revenue should be recorded under the cash method. The answer is simple. Revenue is recorded when the business actually receives payment from the customer. For example, if you send an invoice in March, but the customer pays in April, the income is recorded in April, not March. Expenses follow the same logic. Expenses are recognized when the business actually pays the bill. If you receive a supplier invoice in June but pay it in July, the expense will be recorded in July. Because of this simplicity, many small businesses prefer cash accounting. Owners can easily understand their financial records because they match the bank balance closely. What you see in the accounting system often reflects what is actually sitting in the bank account. However, business owners should still understand that simplicity does not always mean accuracy when analyzing long-term financial performance. That is something we will explore in the next section. Many small business owners choose cash accounting because it is simple and practical. Instead of tracking complex financial events, they only record transactions when money actually enters or leaves the bank account. This makes bookkeeping easier to manage, especially for businesses with limited staff or without a full accounting team. One of the biggest advantages of cash accounting is visibility of real cash flow. When you check your financial records, the numbers usually match the cash available in your bank account. This makes it easier for owners to understand how much money they truly have available to operate the business. Another benefit is tax timing. Under the cash method, income is only recognized when it is received. This can sometimes allow business owners to manage when revenue appears for tax purposes. For example, if a payment arrives in January instead of December, the income may be counted in the following tax year. Cash accounting also has limitations. One important disadvantage is that it does not always show the full financial picture of a business. Imagine a company that completed $100,000 worth of work in December, but has not yet been paid. Under cash accounting, that revenue does not appear until the customer pays. This can make the business look less profitable in the short term. Another limitation involves unpaid bills. If a company receives several supplier invoices but has not paid them yet, those expenses will not appear in the financial records until payment is made. As a result, profit may look higher than it actually is. Because of these limitations, cash accounting works best for smaller businesses with simple transactions and limited inventory. As a company grows and financial operations become more complex, owners often begin considering a different accounting method. Another important question many business owners ask is, which types of businesses can actually use the cash accounting method? In the United States, many small businesses are allowed to use it, especially service-based businesses, freelancers, consultants, and small companies with relatively simple operations. These businesses usually receive payments directly from customers and do not carry large amounts of inventory. Cash accounting works well in these situations because transactions are straightforward. A client pays for a service, the business records the revenue, and the process is complete. There are fewer complications involving inventory tracking, delayed supplier payments, or long billing cycles. Business owners should also ask whether cash accounting provides an accurate view of their company's financial health. Since this method ignores unpaid invoices and upcoming bills, it can sometimes create misleading results. For example, a business might appear highly profitable in a month simply because several large customer payments arrived at once, even though many expenses will need to be paid later. Another question often raised is how cash accounting affects financial statements. Because transactions are recorded only when cash moves, reports like the income statement may look very different compared to accrual accounting. Revenue and expenses may appear uneven from month to month, depending on when payments are received or made. Business owners should also consider how accounts receivable and accounts payable are treated. Under cash accounting, these items usually do not appear in the books because they represent money that has not yet moved. This makes the system simpler but also removes some visibility into future financial obligations. Understanding these factors helps business owners decide whether cash accounting fits their current stage of growth. As a business grows, many owners begin asking an important question: can a company continue using cash accounting forever? In some cases, the answer is yes, but it depends on the size and complexity of the business. Smaller companies with simple transactions can often use the cash method for many years. However, as revenue increases, operations expand, and financial activity becomes more complex, many businesses eventually transition to accrual accounting. One reason for this shift is financial accuracy. Cash accounting focuses only on money that is already moved, but growing businesses need better visibility into future income and upcoming expenses. For example, if a company has large unpaid customer invoices, cash accounting will not show that expected income. Similarly, if the business owes suppliers significant amounts, those obligations may not appear clearly in the records. Another important question business owners ask is how cash accounting affects tax reporting. In many cases, the cash method can simplify tax calculations because income is reported when cash is received and expenses are reported when they are paid. This can make tax planning easier for smaller companies. However, tax regulations and eligibility rules may change depending on business size, industry, and revenue levels. Business owners should also think about how cash accounting affects budgeting and financial planning. Since revenue and expenses are recorded based on payment timing, monthly reports can fluctuate significantly. A month with large incoming payments may appear extremely profitable, while another month may look weak even if sales activity was strong. For this reason, many successful business owners combine simple cash accounting with careful cash flow tracking and financial planning. Cash flow is the movement of money into and out of a business. It is one of the most important concepts every business owner should understand. A company can make sales every day and still run into trouble if cash is not available when bills, payroll, suppliers, or taxes need to be paid. Many beginners focus only on revenue because revenue feels exciting. More sales often look like success. However, revenue does not tell the whole story. What matters is how much cash actually reaches the bank account and how much remains after paying expenses, obligations, and operational costs every month. Profit and cash flow are not the same thing. A business can show a profit on paper while experiencing serious cash shortages. This happens when customers delay payments, inventory sits unsold, or large expenses arrive before incoming payments. Understanding this difference helps business owners avoid unpleasant financial surprises. Think of cash flow as the oxygen of a business. Without oxygen, even a healthy body struggles to survive. The same principle applies to companies. Strong products, talented employees, and loyal customers are valuable, but poor cash flow can create challenges that affect every area of operations. One common mistake is spending future income before it arrives. Business owners sometimes assume upcoming sales will solve current problems. When those sales are delayed or canceled, cash shortages appear quickly. Successful businesses focus on managing available cash rather than relying on money that has not yet been collected. Cash enters a business from many sources. Customer payments, service contracts, subscriptions, consulting fees, and product sales are common examples. Every business should clearly understand where its cash comes from. Knowing the main sources of incoming cash helps owners make smarter decisions and plan growth more confidently. Cash also leaves a business in many different ways: rent, salaries, software subscriptions, equipment purchases, marketing expenses, insurance, and taxes all reduce available cash. Small expenses may seem harmless individually, but together they can significantly affect financial stability if not monitored carefully over time. A simple habit can dramatically improve cash flow awareness. Spend a short period every week reviewing bank balances, expected payments, upcoming bills, and major expenses. This routine creates visibility into the financial health of the business and helps identify potential problems before they become serious challenges. Fast-growing businesses often experience cash flow problems because growth requires investment. More customers may require additional inventory, employees, equipment, or marketing. These expenses usually occur before revenue is collected. Growth is positive, but it must be managed carefully to prevent cash shortages during expansion periods. The first goal of cash flow management is not becoming rich overnight. The first goal is stability. A stable business can pay its obligations, serve customers consistently, and handle unexpected events. Once stability is established, growth becomes easier, safer, and far more sustainable over the long term. One of the best ways to improve cash flow is getting paid faster. Many businesses wait too long to send invoices or follow up on unpaid balances. Prompt invoicing and clear payment terms encourage customers to pay sooner, helping the business maintain a healthier cash position throughout the month. Late payments are a silent threat to many businesses. A company may complete excellent work and generate strong sales, yet struggle because customers delay payment. Tracking outstanding invoices regularly helps owners identify payment issues early and take action before they affect daily operations and financial stability. Building a cash reserve creates financial breathing room. Unexpected events happen in every business. Equipment breaks, sales slow down, or expenses increase unexpectedly. A reserve fund helps absorb these situations without creating panic. Businesses with cash reserves often make better decisions because they are not operating under pressure. Inventory management plays a major role in cash flow. Excess inventory locks money inside products sitting on shelves. While inventory is important, too much of it can reduce available cash. Smart businesses balance inventory levels carefully so money remains available for operations, opportunities, and unexpected business needs. Many business owners focus heavily on increasing sales while ignoring expense control. Growing revenue is valuable, but controlling unnecessary spending can improve cash flow immediately. Reviewing recurring expenses regularly often reveals subscriptions, services, or tools that no longer provide enough value to justify their ongoing cost. Payment terms matter more than many people realize. If suppliers require quick payment while customers pay slowly, cash flow becomes strained. Businesses should work toward payment arrangements that support healthy cash movement. Even small improvements in payment timing can make daily financial management significantly easier. Seasonal businesses face unique cash flow challenges. Sales may be strong during certain periods and weaker during others. Planning ahead for slower seasons is essential. Successful owners save part of their stronger cash flow during peak periods so the business remains stable when customer demand temporarily decreases. Forecasting cash flow helps reduce uncertainty. A forecast estimates future cash coming in and going out. It does not need to be complicated. Even a simple forecast provides valuable insight into upcoming financial needs and helps business owners prepare before challenges appear rather than reacting afterward. Large purchases should always be evaluated carefully. Before spending significant amounts of money, consider how the purchase will affect future cash flow. Some investments generate value quickly, while others take longer to produce results. Understanding the impact on available cash helps prevent unnecessary financial stress. Strong cash flow management creates freedom. Instead of constantly worrying about bills and obligations, owners can focus on serving customers, improving products, and building the future. Businesses that manage cash effectively often experience less stress, greater flexibility, and more opportunities to grow on their own terms. Many businesses fail not because they lack customers, but because they run out of cash. When cash disappears, important obligations become difficult to meet. Employees, suppliers, and service providers all depend on timely payments. Maintaining healthy cash flow protects the business from avoidable financial pressure and operational disruption. Business owners should separate personal and business finances from the very beginning. Mixing expenses creates confusion and makes it difficult to understand the true financial condition of the company. Separate accounts provide clarity, improve record keeping, and make cash flow tracking much more accurate and reliable over time. Discounts can increase sales, but they should be used carefully. Excessive discounting may reduce cash generation and shrink profit margins. Every discount affects the amount of money entering the business. Smart companies evaluate whether lower prices actually improve overall cash flow instead of simply increasing transaction volume. Recurring revenue models often create more predictable cash flow. Subscription services, maintenance agreements, and long-term contracts provide consistent incoming cash. Predictability makes planning easier because business owners have a better understanding of future income and can make decisions with greater confidence and financial stability. Monitoring key financial numbers regularly is essential. Bank balances, accounts receivable, accounts payable, and operating expenses all provide valuable information. When owners understand these figures, they gain a clearer picture of cash movement and can identify trends before they become major financial challenges. Every business should prepare for unexpected situations. Economic changes, supplier issues, market shifts, or sudden expenses can affect cash flow without warning. Planning ahead creates resilience. Businesses that anticipate potential risks often recover faster because they already have strategies and resources available when challenges appear. Growth should never come at the expense of financial stability. Expanding too quickly can place enormous pressure on cash flow. New hires, larger facilities, and increased inventory require funding. Sustainable growth happens when expansion is supported by strong cash management rather than optimism alone. Cash flow management is not a task reserved for accountants. Every business owner benefits from understanding how money moves through the company. Even basic knowledge can improve decision-making. The more familiar owners become with cash flow principles, the more control they gain over business performance. Successful businesses treat cash as a valuable resource. They track it carefully, protect it wisely, and allocate it intentionally. Every financial decision affects future cash availability. Businesses that respect the importance of cash flow often build stronger foundations and remain competitive during both good and difficult times. The ultimate purpose of cash flow management is creating a healthy, sustainable business. Strong cash flow supports growth, reduces stress, improves decision-making, and provides flexibility when opportunities arise. Mastering cash flow is not about complicated formulas. It is about understanding where money comes from, where it goes, and ensuring more stays available for the future. A business owner should know their cash position at all times. Waiting until the end of the month to review finances is risky. Daily awareness of available cash helps prevent surprises and allows faster decision-making when opportunities or challenges appear. Visibility creates control, and control creates confidence. Many businesses focus on increasing sales while ignoring customer quality. Some customers pay quickly and consistently, while others create delays and collection problems. A smaller group of reliable customers can sometimes produce healthier cash flow than a larger group of customers who regularly pay late. Negotiation can improve cash flow significantly. Better supplier terms, lower service costs, or more favorable payment schedules can keep cash available longer. Business owners should not assume every expense is fixed. Professional negotiation often creates financial advantages that strengthen the company's overall cash position. Emergency spending decisions often lead to expensive mistakes. When cash becomes tight, owners may rush into loans, contracts, or purchases without proper evaluation. Strong cash management reduces desperation. Businesses with healthy cash reserves usually have more time to think clearly and choose better solutions. Every dollar has a job. Some dollars pay employees, others support marketing, inventory, technology, or growth initiatives. Viewing cash as a resource with specific purposes encourages discipline. Businesses that assign clear priorities to spending tend to use their money more efficiently and effectively. Regular financial reviews reveal patterns that might otherwise remain hidden. Certain months may produce stronger cash flow, while others create pressure. Understanding these trends allows owners to prepare in advance. Good planning transforms predictable challenges into manageable situations rather than unexpected financial emergencies. Customer retention can improve cash flow more efficiently than constantly finding new customers. Existing customers already know the business and often require less marketing effort. Repeat purchases generate revenue with lower acquisition costs, allowing more cash to remain inside the business and support future growth. Technology can simplify cash flow management. Accounting software, invoicing systems, payment reminders, and financial dashboards provide valuable information quickly. While technology does not replace sound decision-making, it helps business owners monitor cash movement more accurately and respond faster when financial conditions change. The strongest businesses think long-term. Instead of chasing short-term wins, they focus on creating systems that support stable cash generation year after year. Consistency often beats rapid but unstable growth. Reliable cash flow creates the foundation needed to survive challenges and capture future opportunities. Cash flow mastery is a lifelong business skill. Markets change, customer behavior evolves, and expenses fluctuate. Owners who continually monitor, learn, and adapt remain in a stronger position. Cash reserve planning is the process of setting aside money that is not meant for growth, expansion, advertising, or new equipment. Its main purpose is survival. Every business faces unexpected situations, such as slow sales, delayed customer payments, equipment repairs, supplier price increases, economic downturns, or seasonal demand changes. A cash reserve acts like a financial shock absorber that helps a business continue operating during difficult periods. Imagine a small landscaping company that spends about $5,000 each month on payroll, fuel, equipment maintenance, insurance, and other operating expenses. If business suddenly slows because of bad weather for several weeks, the owner still needs to pay bills. Without a reserve, the business may be forced to borrow money at high interest rates or delay important payments. A simple approach is to calculate average monthly operating expenses and build a reserve equal to several months of those costs. The goal is not to make a profit from this money. The goal is stability. Many business owners focus heavily on increasing revenue while ignoring liquidity. Revenue can look impressive on paper, but cash is what keeps the lights on. A practical rule is to treat cash reserves as a permanent business asset rather than money waiting to be spent whenever an opportunity appears. Let us look at a simple example. Imagine a small online store that generates average monthly sales of $20,000. The owner feels confident because sales appear healthy. However, monthly expenses, including inventory purchases, software subscriptions, shipping costs, advertising, rent, and employee wages total approximately $16,000. This means the business needs $16,000 every month just to operate normally. If the owner decides to maintain a reserve equal to 3 months of operating expenses, the target reserve would be $48,000. Instead of trying to save the entire amount immediately, the owner could transfer a percentage of profit into a separate reserve account every month. Suppose the business earns $2,000 in monthly profit and the owner allocates $1,000 toward the reserve fund. Over time, the reserve grows without creating financial stress. Then imagine a major supplier suddenly increases prices, reducing profitability for several months. Because the reserve exists, the owner can continue operating smoothly while finding alternative suppliers. This example shows why cash reserve planning is not about pessimism, it is about preparation. Successful businesses understand that unexpected challenges are normal. A reserve fund provides time to make smart decisions instead of rushed decisions driven by panic. Cash reserves become even more important when customer payments are delayed. Consider a business consulting firm that invoices clients for projects. The firm completes the work today, but some customers may not pay for 30, 60, or even 90 days. During that waiting period, employees still expect salaries and vendors still expect payment. Imagine the company spends $10,000 every month on operations. Suddenly, a large client owing $15,000 delays payment because of internal approval issues. Without reserves, the business owner may struggle to cover payroll. With a properly funded reserve account, operations continue without interruption. This is one reason experienced entrepreneurs often separate profit from reserves. Profit is money earned. Reserves are money protected. They serve different purposes. A practical method is to review cash flow trends from the previous year and identify months when cash balances were lowest. Those weak periods reveal how much reserve protection may be necessary. Many businesses fail not because they are unprofitable, but because they run out of cash before payments arrive. Strong cash reserve planning helps bridge those timing gaps and protects the business from short-term financial pressure. Different businesses require different reserve amounts. A company with stable recurring revenue may need a smaller reserve than a seasonal business. Imagine an ice cream shop that earns most of its revenue during warmer months. During slower seasons, sales may decline significantly while rent, utilities, insurance, and payroll continue. If monthly operating expenses equal $8,000 and the owner wants protection for 6 months, the reserve target becomes $48,000. Throughout the busy season, part of the extra profit should be directed toward the reserve account instead of being spent immediately. Many business owners make the mistake of assuming strong months will last forever. They increase spending during profitable periods and leave little protection for slower months. Cash reserve planning encourages long-term thinking. Every dollar placed into reserves creates future flexibility. When competitors struggle during economic uncertainty, businesses with healthy reserves can continue marketing, serving customers, and investing strategically. Instead of reacting emotionally to temporary downturns, they can focus on opportunities. The reserve account becomes a source of confidence because it reduces dependence on emergency loans, credit cards, and other expensive forms of financing. Creating a cash reserve plan does not need to be complicated. Start by calculating average monthly operating expenses. Next, choose a target reserve amount based on the stability of the business. A stable company may aim for 3 months of expenses, while a more unpredictable business may target 6 months or more. For example, if monthly expenses are $12,000 and the reserve goal is 4 months, the target becomes $48,000. Then create a consistent funding system. A percentage of profit, a percentage of revenue, or a fixed monthly contribution can all work effectively. Keep the reserve in a separate business savings account so it is not mixed with daily operating funds. Review the balance regularly and replenish it whenever money is used. Think of the reserve as business insurance that you control. It may seem unnecessary during good times, but its true value appears when challenges arrive. Businesses that survive economic uncertainty are rarely the ones with the highest revenue. If you're planning to grow your business, there is a good chance you'll need access to funding at some point. Whether you want to purchase equipment, hire employees, expand your location, increase inventory, or improve cash flow, a small business loan can help you move faster. The challenge is that many business owners apply for loans without understanding what lenders are actually looking for. As a result, they get rejected even when their businesses have real potential. The good news is that qualifying for a small business loan is often less about having a perfect business and more about proving that you can responsibly manage and repay the money you borrow. The first thing lenders want to see is a healthy financial picture. Before you submit any loan application, take time to organize your business finances. Make sure your revenue, expenses, profit margins, and cash flow records are accurate and up to date. Lenders want evidence that your business generates enough income to handle loan payments without creating financial stress. Even if your business is relatively small, clear financial records can make a strong impression. Bank statements, profit and loss reports, tax returns, and business financial statements should all be ready before you apply. The easier it is for a lender to understand your business, the more confidence they will have in your application. Another important factor is your credit profile. Many lenders review both personal and business credit history when evaluating loan applications. A strong credit score demonstrates that you have a track record of managing debt responsibly. If your credit score is lower than you'd like, focus on improving it before applying. Pay bills on time, reduce outstanding balances, avoid unnecessary debt, and monitor your credit reports for errors. Even small improvements can increase your chances of approval and help you qualify for better loan terms and lower interest rates. Lenders also want to understand how the loan will be used. One common mistake business owners make is requesting funding without presenting a clear purpose. Instead of simply saying you need money to grow, explain exactly how the funds will be used and how that investment will generate revenue or improve operations. For example, purchasing new equipment may increase production capacity, while additional inventory may help meet customer demand. A lender is more likely to approve a loan when they can clearly see how the borrowed money supports business growth and improves the company's ability to repay the loan. Having a solid business plan can strengthen your application significantly. You do not need a complicated document filled with industry jargon. What matters is showing that you understand your market, customers, competition, and financial goals. Include realistic revenue projections, growth strategies, and expected outcomes from the loan. A well-prepared business plan demonstrates professionalism and gives lenders confidence that you have a clear direction for the future. In competitive lending environments, this can make a meaningful difference. Finally, build relationships before you need funding. Many business owners only contact lenders when they urgently need cash, which limits their options. Instead, establish relationships with banks, credit unions, and business lenders early. Maintain a business checking account, communicate regularly, and demonstrate responsible financial management over time. Lenders are often more comfortable working with businesses they already know. Qualifying for a small business loan in 2026 is not about luck. It is about preparation, financial discipline, and presenting your business as a trustworthy investment. When you focus on strong financial records, healthy credit, a clear loan purpose, a practical business plan, and long-term lender relationships, you put yourself in a much stronger position to secure the funding your business needs to grow. On how to budget for unexpected business expenses. Let's imagine a mid-size HVAC installation and maintenance company based in North Carolina that serves restaurants, schools, and small commercial buildings. The business looks stable because it has recurring service contracts and steady seasonal demand. But we'll break down how they budget for unexpected expenses using real numbers, disciplined allocations, and controlled cash planning. The company generates monthly revenue of $220,000 from installation projects, preventive maintenance contracts, and emergency service calls. Their cost of goods sold, including compressors, copper tubing, ductwork, refrigerants, and labor consumed in installations totals $110,000. That leaves a gross margin of $110,000. Operating expenses include $42,000 payroll for office and field staff, $8,000 rent for warehouse plus office, $3,500 utilities, $3,000 insurance, $4,500 fuel and vehicle maintenance for service vans, and $3,500 miscellaneous overhead. Total operating expenses equal $64,500, leaving operating profit of $45,500 before taxes. So far, the company looks financially healthy. Now here is how they prepare for unexpected expenses. First, they use a rule that 10% of gross margin automatically flows into a reserve account labeled contingency and reactive costs. Since the gross margin is $110,000, they transfer $11,000 each month into that reserve. This account is not for taxes, marketing, or payroll. It is strictly for shocks like vehicle breakdowns, failed equipment returns, refund credits, compliance fines, warranty liabilities, or sudden price spikes in refrigerants. Second, they track unexpected costs using a rolling 12-month look-back model. In the previous year, they experienced a $20,000 van transmission failure, a $9,000 refund credit for a faulty rooftop unit that failed within warranty, and a $5,200 OSHA safety compliance upgrade for ladder harness systems. Total unexpected cost in the year was $34,200. Dividing that total by 12 months gives approximately $2,850 as the baseline monthly shock value. With inflation and supplier price volatility factored at roughly 18% due to metal and refrigerant price fluctuations, their target baseline becomes about $3,360 per month. Let's see how this plays out in real operations. After 6 months, at $11,000 per month, the reserve account reaches $66,000. During the 7th month, one of the service vans suffers engine damage, and repairing the engine plus towing and diagnostics costs $17,500. Instead of delaying customer jobs, taking high-interest equipment, finance, or putting the cost on a credit card, they pay from the reserve. If they had used short-term financing at 15% APR, it would have cost over $2,600 in interest across 12 months. Instead, they avoid interest, maintain credit capacity, and keep service schedules on time. 2 months later, a major installation job produces an airflow issue due to defective duct materials from a supplier. The HVAC company processes a refund credit of $6,800 to the client and absorbs the cost of rework labor. The reserve still holds more than $40,000, so business relationships stay positive, warranty claims are handled professionally, and brand reputation with commercial customers stays intact. Here is the advanced layer. The company uses 3 probability classes for planning. Low probability but high impact events like vehicle accidents or lawsuits are covered by allocating 1% of revenue to contingency value. Medium probability moderate impact events like compressor failures or warranty labor are covered by allocating 2% of revenue. High probability, low impact events like invoice adjustments and overtime hours are absorbed using monthly operating margin flexibility. This keeps decisions rational instead of emotional. By the end of the year, the company used about $31,300 from the reserve, but built it back up to $72,000 using planned allocations and high-demand summer months. The owners now make growth investments like hiring technicians or adding maintenance contracts without fear of being blindsided. The lesson is simple: businesses do not collapse from lack of profit. They collapse from lack of liquidity at the wrong moment. This HVAC company stays stable because it treats unexpected expenses like a mandatory budget line, not a surprise that magically solves itself. A lot of businesses get blindsided not because the surprise expense was huge, but because they never planned for it. Here are the common mistakes, practical tips, and useful tools that make a real difference when budgeting for unexpected business expenses. First, the biggest mistake is treating emergencies as rare events instead of recurring parts of business operations. Machines break, vehicles fail, refunds happen, regulations change, and taxes surprise new owners. Another mistake is mixing operational cash with contingency funds. When everything sits in the same account, owners overspend during good months and choke during bad months. A third mistake is relying only on profit numbers instead of liquidity. Profit exists on paper, but payroll, refunds, repairs, and penalties demand real cash. A fourth mistake is underestimating warranty liabilities, compliance upgrades, and equipment downtime. These don't show up on the income statement until they hit, and then they hit hard. Now let's talk practical tips that actually work. The first tip is to allocate a fixed percentage of gross margin into a separate reserve account each month. This creates predictable funding for unpredictable events. The second tip is to run a 12-month look-back analysis to understand historical surprise costs. You cannot manage what you never measure. The third tip is to classify unexpected expenses into probability and impact buckets. Low probability, high impact items need contingency percentage allocation. Medium probability, moderate impact items need repair and warranty buffers. High probability, low impact items should be absorbed by operating margin flexibility. The fourth tip is to document supplier, legal, and compliance risks once a quarter, so nothing becomes invisible over time. The fifth tip is to plan for timing gaps. A sudden repair in the same month as quarterly taxes or insurance renewals can destroy cash flow if timing is ignored. Now, a few tools serious business owners use. For accounting, tools like QuickBooks Online or Xero help track liquidity, not just profit. For scenario budgeting, software like Float or LivePlan can model what happens when a machine breaks, demand drops, or taxes spike. For maintenance-heavy businesses, CMMS tools such as Upkeep or MaintainX track equipment life cycles and reduce downtime surprises. Tracking daily expenses starts with mindset, not software. First rule: every dollar leaving your business must have a reason you can explain in one sentence. Open one dedicated business checking account and stop mixing personal spending completely. Use one primary debit or credit card only for business purchases so transactions stay clean. Set a fixed daily review habit of 10 minutes at the end of each workday. Open your banking app and scan every transaction line by line. Write down each expense in simple words like fuel, lunch, meeting, packaging material, software fee, shipping, marketing, office supplies, repairs, or utilities. Do not use vague labels like miscellaneous. Create a daily expense cap. For example, decide that daily operating expenses should not cross $300 unless pre-approved. Track cash payments separately because cash disappears fastest. Keep every receipt, even small ones, under $5. Take phone photos of receipts immediately and store them in dated folders. Create a simple spreadsheet with columns for date, vendor name, expense category, payment method, and purpose. Update it daily, not weekly. Assign numbers to categories like 1 for marketing, 2 for operations, 3 for admin, 4 for logistics, 5 for utilities, 6 for food, 7 for travel, 8 for software, 9 for repairs, 10 for taxes. This speeds up tracking. Reconcile expenses every night by matching spreadsheet entries with bank transactions. If one transaction looks unfamiliar, investigate it the same day. Set alerts for every card swipe above a chosen amount like $50. Track subscriptions separately because they silently kill cash flow. Once a week, review all recurring charges and ask whether each one directly supports revenue. Track vendor-wise spending monthly to see which supplier is draining the most cash. Create a daily petty cash limit and lock the cash drawer after that limit is reached. Avoid paying vendors without invoices. Every expense must have proof. Track employee reimbursements daily, not at month end. Use mileage logs for vehicle expenses and record distance in words, not guesses. Track tax-related expenses separately so you do not spend reserved tax money. Compare daily expenses against daily sales, not monthly sales. If daily expenses exceed daily collections for more than 5 days, pause discretionary spending immediately. Track expense timing. Some expenses hurt more because they happen before customer payments arrive. Delay non-essential spending until receivables are collected. Set a daily cash balance floor like $10,000. If balance approaches this level, freeze spending. Write notes beside every expense explaining why it happened. This builds spending awareness. End each day by asking one question: did this expense help me earn tomorrow's revenue? If the answer is unclear, flag it for review. This simple daily discipline protects cash flow better than any complex accounting report. Once basic tracking is in place, daily expense control becomes a cash protection system. Start by forecasting daily spending before the day begins. Each morning, write expected expenses in words such as fuel cost, supplier payment, ad spend, delivery charges, or software renewal. At day end, Compare expected versus actual spending. The gap shows where control slipped. Separate fixed daily expenses from variable ones. Fixed expenses include rent portion, internet, core software, and insurance. Variable expenses include ads, travel, meals, overtime, packaging, and repairs. Variable expenses need tighter daily control. Set spending authority rules. For example, any expense above $100 requires approval, even if you are the owner. This forces conscious decisions. Track payment method patterns. If card spending is rising faster than cash collections, slow it down. Review merchant names carefully. Sometimes the same service bills under different names, causing duplicate charges. Track discounts and refunds daily. Many businesses forget to record refunds, which creates false expense numbers. Use daily expense ratios. Divide total daily expenses by daily revenue. If the ratio crosses 60% for service businesses or 70% for product businesses, investigate immediately. Track expense frequency. Small daily expenses repeated many times cause more damage than one large planned expense. For example, $15 daily coffee equals over $5,000 yearly. Track time-based expenses. Late fees, penalties, and rush charges usually come from poor planning, not necessity. Track employee-related expenses daily per person. This shows spending behavior patterns early. Use notes to record emotional spending decisions, such as buying tools out of stress or urgency. Emotional spending often hurts cash flow most. Track supplier payment terms and mark due dates in advance. Late payments cause penalties, while early payments reduce usable cash. Track cash inflows and outflows on the same sheet so you see timing gaps clearly. If expenses go out before money comes in, cash stress increases, even if profit exists. Create a daily expense stop list. These are expenses you pause immediately when cash feels tight, such as ads, non-essential travel, upgrades, or consulting. Track inventory purchases daily and compare with actual sales movement. Buying inventory faster than selling drains cash silently. Monitor expense spikes. Any sudden jump in daily expenses must have a written reason. Track trial subscriptions carefully and cancel before renewal dates. Track currency conversion fees if you deal internationally because they add up quietly. Review bank charges daily, including transfer fees and service fees. Many owners ignore these until month end. Create a daily closing ritual. Before ending work, confirm that every expense is logged, categorized, justified, and matched to cash balance. End with one question. If tomorrow's sales stop, can today's spending still be defended? This daily discipline turns expense tracking into a habit, not a task, and protects cash flow long before financial trouble appears. 3 money mistakes that don't look dangerous at first. They feel normal, they feel common, but behind the scenes, they quietly destroy businesses every single day. Mistake number 1, the sales addiction trap. One of the most common and dangerous money mistakes is becoming addicted to revenue numbers instead of focusing on sustainable profit. Many business owners wake up every day obsessed with sales targets, more orders, more clients, more volume. On the surface, this feels like success, but revenue is not the money you keep. Revenue is simply money that enters the business before expenses eat it up. This mistake starts when owners say yes to everything. Low margin deals, heavy discounts, expensive customers who demand more support but pay the same. The thinking is simple. If I sell more, everything will be fine. But what actually happens is the opposite. Costs rise faster than income. Staff workload increases. Marketing spend goes up. Operations become messy. Yet profit stays flat or even shrinks. Many businesses look busy but are financially weak. The owner works longer hours but takes less money home. Cash stress becomes normal. Even in high sales months, the bank balance feels tight. That's because profit was never protected. The business was built on volume, not value. This trap becomes extremely dangerous during tough times. When costs increase or demand slows down, thin margins leave no room to breathe. Owners panic and push even harder for sales, often cutting prices further, making the situation worse. It becomes a cycle that is hard to escape. Sustainable businesses think differently. They know their numbers clearly. They understand which products, services, and clients actually generate profit. They are willing to lose bad sales to protect healthy margins. They raise prices when needed and improve efficiency instead of blindly chasing growth. A business doesn't survive on excitement, it survives on profit. If your business looks successful from the outside but feels stressful from the inside, this mistake is likely draining it quietly. Mistake number 2, turning your business into a free bank for customers. Another silent killer is allowing unpaid invoices to pile up without strict control. Many business owners underestimate how dangerous this can be. An unpaid invoice is not just delayed income, it is money already earned but not available for use. And when too many invoices stay unpaid, cash flow collapses. This mistake often comes from fear. Fear of upsetting clients, fear of looking unprofessional, fear of damaging relationships. So owners avoid follow-ups. They send one reminder, then stay silent. Meanwhile, expenses continue as usual. Salaries, rent, suppliers, utilities, and taxes do not wait. Slowly, the business starts suffering even though sales are happening. Owners dip into savings. They use credit cards. They take short-term loans just to survive. Ironically, the business appears profitable on paper but feels broke in real life. Over time, unpaid invoices change how a business operates. Planning becomes difficult, growth decisions are postponed, stress becomes constant, the owner starts reacting instead of leading. The worst part is that late-paying customers often continue paying late because they learn there are no consequences. Strong businesses treat cash flow as a priority, not an afterthought. Clear payment terms are set from the beginning. Follow-ups are consistent and professional. Advance payments are used where possible. Late fees are clearly communicated. This is not about being aggressive. It is about being responsible. Getting paid on time is not rude. It is necessary for survival. A business cannot grow, invest, or stay stable if its money is stuck outside. If you are always busy but constantly waiting for payments, this mistake is slowly draining the life out of your business. Mistake number 3, operating without a financial safety net. Many businesses operate with zero protection against surprises. Every dollar that comes in is immediately spent. Whatever remains is either reinvested or withdrawn. There is no reserve, no emergency fund, no buffer. Everything depends on things going perfectly. This works only until something goes wrong. A machine breaks down, a vehicle needs urgent repair, a key employee leaves, a legal issue appears, a sudden market slowdown hits. Without a safety net, even a small problem becomes a major crisis. When emergencies hit, owners panic. Decisions become rushed and emotional. High-interest loans are taken. Credit cards are maxed out. Growth plans stop completely. In extreme cases, businesses shut down not because they were unprofitable, but because they were unprepared. This mistake is especially common in small businesses where survival mode becomes normal. Owners believe setting aside money means losing growth. In reality, emergency funds protect growth. They provide stability during uncertainty. They give the owner time to think clearly instead of reacting out of fear. A financial cushion changes everything. Repairs don't feel scary, slow months don't feel fatal, opportunities can be evaluated calmly, the business becomes resilient instead of fragile. Strong businesses plan for problems before they arrive. Weak businesses hope nothing will go wrong. Hope is not a strategy, preparation is. If one unexpected expense can shake your entire business, then this mistake is already limiting your future more than you realize. To solve these 3 money mistakes effectively, small businesses must rely on the right financial software tools instead of manual guesswork. For the mistake of chasing revenue instead of sustainable profit, accounting and profitability software is essential. Tools like QuickBooks, Xero, Wave, and Zoho Books help track real profit after expenses, not just sales. Profit margin calculators, break-even analysis tools, pricing software, and cost-tracking apps show which products or services actually make money. Cash flow forecasting tools such as Float, Fathom, or Plan Guru help predict future shortages before they happen. For unpaid invoices piling up, invoicing and payment collection software plays a major role. Tools like FreshBooks, Zoho Invoice, QuickBooks Invoicing, Stripe Invoicing, PayPal Business, and Square allow automated invoices, recurring billing, payment reminders, instant payment links, and multiple payment options. Invoice aging reports and customer payment history dashboards clearly show who is delaying payments. For building a financial safety net, expense control and savings automation software is critical. Expense tracking tools like Expensify, Pleo, Ramp, and Zoho expense identify unnecessary spending. Subscription management software such as Rocket Money, Spendesk, or Subby prevents silent cash leaks from unused tools. Budgeting and reserve planning apps help allocate money for repairs and emergencies automatically. Separate digital business banking platforms like Mercury, Brex, Wise Business, or Novo make it easier to keep emergency funds untouched. Financial dashboard software combines revenue, expenses, invoices, and reserves into one real-time view, reducing stress and confusion. If you found this masterclass helpful, like the video, subscribe to the channel, and I'll see you in the next one. Thank you for watching.